Good morning, everyone, and welcome to this month's HUBsights webinar. My name is Karen Arthur, and I work in the marketing team here at HUB24. Before we start, I need to mention a few housekeeping items. The lines will remain muted throughout the presentation to prevent any background noise, so if you do have any questions, please use the webinar control panel to send them through to the team. We will hold a combined Q&A at the end of the session. Today we're joined by Andrew Fleming, Deputy Head of Australian Equities at Schroders, who will share his insights on Australian equities. Andrew will be followed by Damien Cottier, Portfolio Manager and Senior Equities Analyst at Perennial, who will present True to Label Responsible Investing, a small caps approach. So without further ado, I'd like to hand over to you, Andrew.
Thanks very much, Karen, and good morning, everybody. Thank you very much for your time. We've got 20 minutes for this first presentation. I've got about 10 slides, so we'll be moving through them pretty quickly, and then I'll hand over to Damien. Just if we start with where multiples are at the moment with the market, obviously we had a bit of a one-way trade for the better part of the last couple of years up until 6 weeks ago when we've had a bit of a shakeout. But overall, even though the market's been very strong, there's been extremities, as you can see in this chart. What it does is, by sector, show you what the last 10 years PEs have been and where, with the green diamond, we sit at the moment. So if we just focus on energy to start with as an example, you can see there that vertical line from the low point being about 70 going up to almost 200. That shows you what the 5th and the 95th percentiles through the last 10 years by month look like. So you can, and the rectangle in the centre is effectively the 25th to the 75th percentile. So for something like energy, you can see that we're on the cheap side of that average range of the blue rectangle in the centre, but not at an extreme. As we move along, the bifurcations are pretty clear. So you can see that for 4 of the 13 sectors, so a minority, they're in the blue rectangle, or pretty much within that average range through time. So you can see materials is in there, industrials is in there, and as we move along, utilities and REITs are both in that sort of rectangular area where the PE for those sectors are pretty much in line with the averages, plus or minus a little bit, compared to what they have been on average through the last 10 years. The more interesting bit is what are the extremes, because you can see that on the upper end, consumer discretionary is in the upper quartile of what multiples have been through the last decade. As we move along, consumer staples has only been this expensive about 5 months in that 10-year period on a PE basis. Healthcare is not a lot better, and you can see IT is still a standout where it's still at a very expensive level compared to pretty much every period through the last decade. On the other side of the equation, the stocks and sectors that are below the rectangle and looking cheap compared to their own history through the last decade tend to be clustered over in the right. So you can see their resources are cheap, banks are cheap, telcos are cheap, and then all the way back to the end, energy is cheap. Those sectors have probably got 2 things in common. So one, they tend to be big, so that those cheapest sectors account for those for more than half of the market cap. And secondly, they're very out of favour. So the cheapest sectors are the ones at the moment where people are saying, telcos, Telstra is stuffed, it's pretty obvious. Banks, the Royal Commission thinks are only going to get tougher. And resources and energy are stocks that have grown quite a bit, but everybody always talks about their volatility. So in the main, the market would be underweight those sectors, and they are the ones at the moment, though, relative to their 10-year history, that are at relatively attractive levels on a multiple basis, whereas those that are on their least attractive multiples, in particular things like IT and healthcare, the sectors that probably still are most in favour with the market even after the last 6 weeks. Part of that's based on myth, and what this chart does is say, okay, is that just because you're getting a lot more growth? So is it perfectly fair and rational to pay a much higher multiple for things like healthcare and IT because that's where the earnings growth is coming from, as opposed to banks, resources, energy and telcos that we just went through where, as everybody knows, you're not getting any growth, right? Well, no, wrong. As this chart shows, you can see there on the left, the ASX 200 in total in the last year has given you in the low to mid-teens as a total return, which is that purple diamond. And for each sector, we've broken it down into earnings growth being the dark blue, the dividends you get in the light blue, and then the extent to which the sector's re-rated in the green or derated, where the green's below the line. So just stop and have a look at that and have a look at where you have got earnings growth. Where's the dark blue by sector? As we cast our eyes along, you can see by far the biggest two are energy and materials, the first two. And materials is mostly resources. That's actually where the earnings growth has come from. Those sectors that have had the best performance, so IT, you can see there hasn't been any earnings growth whatsoever. All of that return is green, is re-rating, and similarly with healthcare, it's not quite as extreme, but certainly the majority of it is re-rating. In other words, as investors, what we're not paying for really is earnings growth. We're paying for the promise of future earnings growth at the moment, and that willingness to pay for that promise has increased exponentially through the last year, which has led to that green preponderance in the re-rating. Perversely, and just before we leave that chart on the left, where that earnings growth has been delivered most, so you can see there on the left with energy and materials, those sectors have been derated, so the green's gone down. So the more that these companies have earned through the last year, because people have rightly said, well, I think the iron ore price is at an unsustainable high. I think the oil price is at an unsustainable high. We'd agree with that, but because of that, those sectors, the green goes down, those sectors have been derated. It's interesting, though, to think what other sectors are at cyclical highs in terms of their earnings, and why wouldn't investors also apply the same degree of prudence in terms of future earnings from those sectors? On the right, all we're doing here is looking at this in a different way, where we're saying on the horizontal axis, what's the ROE or the return on equity that sectors will provide through the next 12 months? And on that vertical axis, what perpetual growth is needed to justify that PE if the ROE is maintained? So if, like healthcare on the top right, you get a 21% ROE, not just this year, but forevermore, you need, as well as that record level of return on equity, you need to maintain a very high growth rate of 5 or 6% into perpetuity. And the same goes for the IT sector. Whereas you can see there for telcos, something like Telstra, obviously, which is getting pretty much the best ROE outside of IT and healthcare in the market, is still being priced for negative growth into perpetuity at its current level. Just moving on into the market as a whole and its multiple. One way we look at to try to get a sanity check locally and globally as to how full or otherwise multiples are at a point in time is to look at this chart, which simply shows you what the global M&A cycle has looked like in terms of US dollars and trillions that are spent through time. Have a look at when it's peaked, 2000, 2007, and this year is actually higher in dollars than any of those prior peaks. Typically, like investors, companies are pro-cyclical. They do it, as you can see there, across regions. There's nothing that's specific to any continent in this behaviour. Human nature being what it is, everyone loves a winner. People get more optimistic as gains have been accrued. Generally speaking, right now, history would suggest in 2000 and 2007, the winners in those transactions, those big transactions, were the sellers, not the buyers. Our sense would be that right now, the winners through time in 2018 for those transactions will also be the sellers and not the buyers. The next couple of slides, we're just trying to bring back to the Australian environment exactly why some of these stocks have done really well, these IT stocks in particular, and we saw that they were at record multiples up front. And we went and had a look at the accounts for these US FANG stocks to try to get a better sense as to what their dynamics really are. And some things struck us, such as this slide, where it shows, and this is something we've taken from Morgan Stanley, just in the first quarter of this year, Amazon's year-on-year growth in gross profit dollars was $7 billion US. And you can see there, Facebook was about half that, Google was a little bit less again. But to put it into context, Amazon's growth in dollars was 5 times Home Depot plus Costco plus Walmart plus Target plus Lowe's combined. So you put those 5 big US retailers together, add them up, times it by 5 in dollars, that equals Amazon's growth. Remember, we weren't getting earnings growth when we saw the slide up front for the Australian sectors. We're being asked to pay the highest multiples for. Most of what we were paying for was re-rating. Actually, in the US, investors there for these stocks are receiving significant amounts of dollars in growth right now, not just promised into the future. The other big difference between those FANG stocks and the Australian peers is their balance sheets. They tend to have no debt and very little goodwill. So all of them are pretty much growing just organically. Amazon's the only one with any material goodwill balance, and it's sub 10%. The final thing is the plowback rate. So for each new dollar of sales that they write, not only are they getting a lot of dollars coming through the gross profit, but they're also reinvesting very aggressively. They're reinvesting as to about 80% of their new revenues to make sure that their business continues to be future-proofed. In contrast, if we have a look there on the left, they're the Australian stocks that are IT related and what their price to future sales multiples are at the moment. So you can see something like Afterpay at 30 times, WiseTech at 20, etc. And over to the right, you can see you can buy things like Facebook, Alphabet, Apple, and Amazon, the ones we were just looking at, in the main for 4 to 5 times sales on average. 4 to 5 times sales is a lot lower than what you're having to pay for those Australian stocks in the main. Their multiples are very high, and if you look at their financials, they tend not to be generating anything like the cash flows, let alone the cash flow growth that we saw in that earlier slide with what we saw with Amazon and Apple and Alphabet. Just before we leave that, one final point to make. If all you do is get derated from 20 times forecast EV to sales down to those multiples paid for Alphabet, Apple, Amazon of 4 to 5, you've lost 75% of your money. So when people say, oh, last month was a big correction, with some stocks on that list that have gone up in 2 years over 200%, when they're down 25, we actually don't think it's that big a correction. And when you look at those multiples, you can start to get a better sense of dimension as to how much of a fall could still be in store. This is a comparison that my colleague Martin wrote about a couple of months ago in our monthlies, where to bring this to life, he said, let's compare Rio and CSL. The reason why we compared them is that they had a very similar EV, as you can see there on the bottom right, or the EV is the enterprise value or the market cap plus the net debt. So effectively what the market was pricing the asset value, the market asset value of the company to be at a point in time. So Rio was about 120 billion and CSL was about 108 billion when we did this chart a few weeks ago. The fundamentals though are very different. So you can see on the left, in comparison, Rio's got about 60 billion of sales and CSL's got about 10. So the multiple that you're paying for Rio in terms of its sales is roughly 2, as you can see there with that blue diamond, whereas you're paying about 10 times sales for CSL. Where the rubber really hits the road is over to the right. So you can see that's the EBIT that Rio produces, so it's doing almost 10 billion in EBIT. In other words, you're paying about a 6 times multiple for Rio, whereas with CSL, given that the EBIT's only a couple of $1 billion, that multiple's akin to 30 times. Or you're paying 5 times the multiple for the earnings for CSL today than you are for Rio. And remembering the first slide, it's not readily explained by growth, even though that would be the easy response to make. Certainly not in terms of the most recent experience in the last few years. One other factor that investors are probably quite blasé about until it hits them in the head at the moment is regulatory risk. If we think about the banking sector in the last year, if we think about the NBN impact upon Telstra, some of the issues that have arisen with regulatory issues in gaming, regulatory risk in Australia and around the world is a pretty large impact in terms of equity performance. One of the sleepers for investors in the Australian market might be that a lot of the buoyancy in healthcare stocks has been driven by earnings growth, but that earnings growth has tended to come from the US. What this chart does is say, why is that, and what could change with this through time? So what we've done here is Sally Warnford, our healthcare analyst, said, let's go back to the year 2000 and benchmark pharmaceutical products against consumer prices in green. So you can see there, if you were to think about the CPI being the green line, what would that look like if you just did call it a PPI as in a pharmaceutical product index? And you can see there that in both Australia and the UK, that PPI, for want of a better term, has consistently been below the CPI through that 20-year period. In other words, if we're a drug company, the government, which is the big buyer, says every year, you know and I know, there's probably going to be more demand for your product, and you know that I'm going to have to give you a subsidy. Nobody as a drug company goes and sells their products on eBay and just sells it out to the highest bidder. Prices are set by regulatory forces, and generally those governments are saying, because I'm giving you this guaranteed demand and because you're getting a good return, I want some pricing power for that. On the right there, you can see the biggest market of all hasn't done that. And funnily enough, it hasn't always been that way. It really kicked in when Obama became president. So since 2008, that blue line's really motored away from the green line in the US. Interestingly, last week, Trump put forward a proposal where the US index drug prices, what they call category B drugs on Medicare schedule, to a very clever concept where they're going to use an index of international prices. And you can see, just looking at that Australian and UK chart, why rather than saying, well, the right price is this, and the drug company saying, no, it's that, all they're going to do is say, well, look, you've already negotiated with Australia and the UK and a list of about 10 other countries. We're just going to take the average of those prices. If all that does is bring that blue line down towards the green line on the right with the US, that could have a pretty big impact on the profitability for a lot of those Australian listed healthcare stocks. Finally, in terms of the banking sector, they're clearly getting hit from all sides. All this chart does is give you a context through time as to what has been in green, the growth in business credit and housing credit in blue. You can see that they're both converging towards and just below 5%, and we actually think that deceleration will continue or get down towards zero. If you run a bank right now, the only way you're going to be able to grow your profits, given your bad debts are also at record lows, is to continue to cut your costs, which basically means people, you've seen them all start to head down that direction. That's probably only going to continue. To the extent that these blue and grey lines decelerate and don't kick up from here, and everything you read at the moment is about tightening credit standards, not loosening them, and everything coming out of the Royal Commission would suggest there's downward pressure on credit, not upward. That means those cost-cutting measures by the banks will only have to increase. Finally, a bit of good news. What does look good in this environment? The waste sector is something we think looks attractive, and Bingo and Cleanaway are stocks that we own. They can produce pretty good returns on capital, as you can see on this vertical axis, and are priced at reasonable multiples of EBIT. So we saw earlier things like Rio were sub 10, so to the left on this chart, but something like CSL was way out on the 30s, so far over to the right, whereas you can see what we'd like to buy are things that produce reasonable returns on that vertical axis, but if we can buy them at 10 to 15 times EBIT, generally on behalf of our investors, we're pretty confident we should be able to make some money through time. So in summary, just bringing that to a head, just the four things we'd like to leave you with, that valuations are full, but the disparity is a much bigger issue, which is that point about market PEs are meaningless when a lot of things are outside of that 25th to 75th percentile band. A lot of those extremes aren't just reflecting earnings growth, they're more around emotive themes. Obviously, to the extent that QE is phased out and local credit conditions continue to tighten, that will have an impact upon sectors. And finally, beware of debt. Debt can often be a big killer, a hidden sleeper for companies as conditions tighten in this environment. And so with that, I'll pass over to Damien. Thanks.
Thanks very much, Andrew, and welcome everybody to the webinar. And Thanks for taking the time out of your no doubt busy day to listen in. I'm really excited to be talking to you today about responsible investing and our new small companies responsible portfolio. I'm wanting to cover off a few things today. Oh, sorry, I'll just get the slide. First is, what is responsible investing? Secondly, I want to talk about our heritage in small cap investing and why we think small cap stocks are an interesting place to invest. I then want to discuss our investment process for the new smaller companies responsible portfolio, and finally provide you with some examples of stocks that are currently in the portfolio. At the end of today, I'm hoping that you'll have a better idea of why our smaller companies responsible portfolio is an interesting alternative for investors who are looking for true to label exposure to responsible investing. So getting right into it, staying on slide 2, responsible investing is an area with a lot of acronyms and buzzwords. Trying to cut through the noise though, it is best seen as an approach to investing that incorporates environmental, social and governance issues to generate sustainable long-term returns for investors. Moving on to the question of why the increased interest in responsible investing in recent times. Responsible investing is becoming more mainstream for a couple of reasons. Partly as a response to topical issues such as climate change and the media focus on poor corporate culture, as most visibly seen in the Banking Royal Commission. Partly it's resonating with the young, as well as the young at heart. And interestingly, it seems like this is one way in which to get young people more engaged with investing in superannuation, which is only a good thing. And I think it's partly an acknowledgement by investors that as it becomes more mainstream, companies which are engaged on ESG issues will do better, both with their customers and for their investors over time. Whatever the reason, the one thing that is clear is that responsible investing is now becoming more mainstream. Turning now to why we think small caps are an interesting place to invest. First, as you can see here on the slide, the small caps universe is relatively large and many stocks are either not covered or relatively poorly covered compared to their large cap counterparts. Moving on to slide 4. The other reason is stockbrokers have cut back on research teams in recent times, and that's meant that small caps are an even more under-researched universe now. As you can see on the chart on the left, the reduced number of earnings estimates for small cap stocks in recent years, and the chart on the right shows that increasingly the earnings estimates are stale by the time you get around to reporting season, which presents opportunities for proactive investment managers. We also like small caps from a responsible investment point of view, as we have the opportunity to engage with management on ESG related issues in smaller companies to a greater extent than we do with larger companies. Turning now to the heritage of the Perennial Small Caps team. As you can see on this slide, we have a well-resourced team of 7. This is one of the better resourced small caps teams in the Australian market, and we've deliberately bolstered it over the years as we have seen the level of broker research decline. 3 of our team are former stockbroking analysts, including Andrew Smith, who is head of small caps. I manage the responsible investing portfolios, and I'm ably assisted by Marnie Lysart, who, amongst other analyst responsibilities, is focused on ESG issues. I should also mention that the team seeded our initial responsible investing product, the Sustainable Future Trust, with our own funds. Also worth mentioning is our team has a policy of not personally investing in ASX small cap stocks to avoid any conflicts. Any exposure must be through our funds at the same fees as our direct clients. So I hope you can see that we have a well-resourced and aligned small caps team. Continuing on with the theme of our small caps heritage, on this slide you can see our small caps fund has a track record back to 2002. As you can see from the slide, the performance has been pretty solid, and in case you're wondering, these numbers are all net of fees. We also launched our micro-cap portfolio last year, which has also had a pretty decent performance, although a fairly short time period given it only started in 1 February 2017. We've also had some broader recognition with our Small Cap Companies Trust announced as the winner of the Small Caps category at the recent Zenith Fund Awards. So in summary, while we need to highlight that past performance is not an indicator of future performance, We're pleased that we've been able to deliver solid historical returns for our investors. Moving on to talk more about our responsible investing funds and what we are trying to achieve. Our goal is to invest in companies which are making a positive contribution to creating a sustainable future. In doing this, we're looking to create a true-to-label responsible investing portfolio. Importantly, we're seeking to do this in a way that does not compromise returns and ensures the portfolio is adequately diversified, typically holding 30 to 45 stocks. And as mentioned on the slide, we also like companies with solid balance sheets, preferably net cash. To me, a key strength of the portfolio is that we have experience in small and micro cap investing. We have a broad coverage universe, and we're also used to seeking out investments beyond the usual suspects. And we have a familiarity with companies in a wide range of the market cap spectrum in the Australian market. So in summary, we're looking to invest in companies making a positive contribution towards creating a sustainable future, and to do that in a sustainable way from an investment perspective. So how do we seek to implement our goal? Firstly, we don't invest in companies exposed to thermal coal, oil and gas, gambling, or the sale of weapons, tobacco, alcohol, or unhealthy fast food. We also have what we loosely call the smell test. And we exclude stocks which, I guess you could say colloquially, don't smell right, taking into account the types of things that our investors are looking for us to invest in. The second, what we are trying to do is invest in companies which are making a positive contribution to creating a sustainable future, and I have a few examples of those later in the presentation. Thirdly, we also invest in companies which are not in the first two categories, but have a perennial-derived ESG score that is better than the market. This provides some diversification. At present, the portfolio is invested around a third in so-called positive contribution companies, with a balance in an companies with an ESG score better than the market. Over time, though, we're aiming to get this towards 50 to 60% of the portfolio in companies making a positive contribution. Although we'd like to outperform that over time, but this depends on the opportunities that present in the market. You should also note that as the portfolio is largely small cap stocks, it avoids the issues around major banks, supermarkets, and large resource companies. So just to reiterate again, what we're seeking to do is invest in companies making a positive contribution to the sustainable future, and do this in a sustainable way from an investing perspective. Moving on to the next slide, I just want to run through our process in a little bit more detail. The key point is that it's not a quant process, but seeks to integrate our stock picking heritage with ESG considerations. We don't have a separate silo of ESG people. We integrate the ESG considerations into our investment process, which we see as an advantage. Two key components of our process are our ESG database and the ESG scores that our analysts attribute to each stock. We have our own ESG database, which includes data on around 40 different factors across each of the environmental, social, and governance components. And we currently have around 400 stocks in our database. A few of the data items are referred to in the slide. These include greenhouse gas emissions, water use, injury rates, and board composition, to name just a few. Based on this information, but also based on our engagement with the company on ESG issues, each analyst then derives a score for a company's performance on each of the environmental, social, and governance factors, taking into account both the measures in the database and the discussions with management on relevant topics. The analyst then produces an ESG score which feeds into the rest of our process. So the key takeaway here is the process isn't a quant process and seeks to integrate our stock knowledge with responsible investing considerations. Moving on to the next slide, one of the key aspects of our process is our engagement with companies on ESG issues. Set on this slide is an example of Huon Aquaculture, which is a stock that we've been actively engaging with to get a better understanding of the ESG issues involved. These have included understanding Huon's exposure to Macquarie Harbour and the actions it has taken to minimise the impact of its operations on the environment. We're also encouraged that it received RSPCA approval, the only Australian salmon producer to have this, earlier this year. One of the key takeaways here is that our analyst, Marnie Lysart, went above and beyond in the cold, windy weather of Tasmania to see the operations up close. This next slide highlights some of the other examples of engagement that we had with companies on ESG issues. Not all of these companies are in the portfolio, but it's important to note that we have over 1,000 company contacts a year, which provides a great base for us to discuss relevant ESG issues with both companies in the portfolio and other companies in our investment universe. Moving on to slide 12, another key part of the process is the Perennial Responsible Investment Screen, which ranks the small and mid-cap stocks in our investment universe having regard to the ESG score, which I mentioned earlier, together with valuation and balance sheet metrics. Once again, it's not a quant process, so we take the stock ranking on the responsible screen into account to select a portfolio, which typically has around 30 to 45 stocks, currently about 35, and the position size is determined taking into account sustainability, valuation, and liquidity. I should also mention our approach to valuation is slightly different for this fund. While we look at the portfolio through a value lens, valuation is only one factor that we take into account when constructing the portfolio. So the key takeaway here is that it's not a quant process, and we expect the portfolio to hold around 30 to 45 stocks, and currently about 35. Set on the next slide is a few of the companies that we have in the portfolio that are contributing to a sustainable future. This slide deals with clean energy stocks. We've got a few in the portfolio. The first is Meridian Energy. This is a New Zealand renewable energy company, which is very focused on generating clean energy and owns around 50% of the hydropower assets in New Zealand, as well as having clean energy assets in Australia. Not only does it generate clean energy, but is focused on sustainability more broadly, with one of its recently announced initiatives to convert 50% of its car fleet to electric vehicles. Another stock is Mercury Energy. This is also a New Zealand renewable energy company, and it generates both hydro and geothermal energy. An interesting stat from New Zealand is that they generate around 70% of their power needs from renewable sources, which I was quite blown away by the first time I heard. And companies over there seem to be really focused on sustainability as an issue. Finally, on the clean energy side, there's Infigen Energy. Infigen owns mainly wind generation assets in Australia, and is in the process of developing a battery to complement electric battery to complement its wind energy assets in South Australia. I guess one of the key points in this slide is that there is some diversification across a number of clean energy stocks. Moving to slide 14, this sets out a number of other stocks that we see as making a positive contribution. Firstly is Janison. This is a digital testing and learning company. It developed the NAPLAN online testing platform. One of the interesting aspects of the NAPLAN software is they develop functionality that allows the software to be used for online testing in remote communities. Janison's now exporting that technology to other parts of the world, and is also seeking to use it for new applications. Next on the slide is Long Table Group. That's a biodynamic and organic dairy product company which sells through the Paris Creek, St. David's and Maggie Beer brands. Another company is Mathletics. It's 3PL. This is a company which runs the global Mathletics learning tool. It's a product which my children have had a fair bit of interaction with, although not quite enough according to some of the responses that I got from my daughters last night when I asked them whether they'd been using it lately. Finally, there's TradeMe, which is, amongst other things, a second-hand good trading platform in New Zealand, which is its genesis. So once again, there is some diversification across sectors with these stocks which are contributing to a sustainable future. Page 15, there's been some discussion in recent times about the mapping of portfolios to the United Nations Sustainable Development Goals, also known as the SDGs. While there are arguments as to how appropriate this is in the context of a listed portfolio, I've set out a breakdown here of the stocks in the portfolio that directly relate to a few of the SDGs, given that some people like to think about a portfolio from that perspective. The key takeaway here is that around 58% of the portfolio is directly involved in activities referred to in the SDGs. I just briefly wanted to touch on performance. We've only been going for a very short period of time. We really only commenced mid-July, so it's extremely early days, but I thought I might get questions on this, so I thought it's better to put in a slide. While the performance is struggling in absolute terms, like a lot of the market, it's just done a little bit better than the market, than the small orders industrial benchmark. So the benchmark is the small orders industrials, given our main focus on industrial companies rather than resources companies. So before we open up to questions, I just wanted to leave you with a few key thoughts. I guess the first one is that responsible investing is becoming more mainstream. Secondly, as it becomes more mainstream, I believe that companies that are engaged from an ESG perspective will do better, both with their customers and with investors. Thirdly, Perennial has a well-resourced team with a strong track record in small cap investing, and we've developed what we think is a true-to-label responsible investing portfolio for Australian and New Zealand companies. And finally, and most importantly, we're really excited by the opportunity to contribute to sustainable investing, but we want to do that in a way that achieves solid, sustainable investment returns for investors. So I hope you now have a better idea of why we believe the small cap companies responsible portfolio is an interesting alternative for those looking for exposure to small caps and responsible investing. So with that, I'll hand over to questions.
Great, thank you so much. Guys, we're going to open up to questions, so please use the webinar control panel. It should be on your screen right now. It looks like we've got a couple that have come through already. Andrew, this one's for you. How do you differentiate between momentum and where a price premium may be warranted?
So it really picks up on some of the themes that Damien's spoken about. So to us, it's all to do with what does a company look like in 5 or 10 years? So what actually is durable, what has a natural role and a place in the market, and in the event that that's not easily identifiable, it's much more likely to be just momentum. So a good way of thinking about that is defining why is a company better, and there's a couple of objective things you can point to. So is, for example, in one of the companies that Damien spoke to, we own quite a lot of, a company 3PL, which owns Mathletics. Is this technology actually better? I think a lot of people in Australia would know it's pretty commonly adopted through a lot of schools here as it is in the UK and South Africa and other countries, but is it winning or losing market share? If it was losing market share, well then that would suggest to us that the product's losing relevance, it's no longer better. The ways you can differentiate yourself are being better, by being cheaper, and generally we'd want to see some tangible recognition for that in the form of, are you winning market share? Is your revenue growth greater than peers? Are your margins higher? The final thing is getting back to sustainability. If a business isn't profitable, that's also highly unlikely to be something that is anything other than a transient momentum-based entity. Sustainability in terms of underlying cash flows, funding operations as a business grows is incredibly important. And the final thing is organic growth versus acquired growth. A lot of things which have done very well on the Australian market through the last 12 months have just effectively been roll-ups. Some of them even have been called IT companies, but when 80% of your growth is from acquisitions, that's a very different scenario to those FANG stocks we saw listed in the US, whereas I mentioned something like Amazon has got almost 10% in goodwill, but most of the others have got closer to zero. There's one listed Australian IT company which has done very well in the last couple of years, which has now got 80% of its assets in the form of goodwill. In other words, businesses that it's acquired through the course of the last few years. As we've seen more recently in some other industries, and there's been a couple of really big falls this year, roll-ups can often do very well on the way up, but they can often, and usually, spectacularly unwind as well. So there's some of the tangible pointers we look to in trying to determine whether something's sustainable or whether there's just it's a momentum-based fad, which tends to be quite ephemeral from an investment perspective.
Great, thank you. Damien, question for you. Do you use any external data providers?
We use a data provider for carbon data because that's quite difficult to get to forecast. We also use a proxy advisor, but we don't subscribe to any of the other mainstream services. At present, we find that once you get down to, a lot of them only cover the ASX 200. Once you get down into small cap stocks, the data is a bit less reliable. We prefer to do our own work and do the hard yards ourselves rather than rely too heavily on the data providers.
Stand in the rain and the cold. Yeah. Andrew, what are the main issues for regulated entities like banks, financial services and utilities?
And healthcare, the Trump example we gave. And I think that's a really good one in that the main issue is it's a whim. It can just change overnight. If you own shares in Star Casino, you thought you owned the right to the casino and serving Greater Sydney area for quite a long period of time until you woke up one morning and found that the then Premier had decided to give a licence to Mr. Packer as well across the harbour. So that change had a pretty material impact upon the valuation the market described for Star Group immediately. If you're a bank equity owner, the impact of the banking levy and now some of the Royal Commission issues and the regulatory knock-on from that have seen you underperform the market by circa 25% through the last year, or in dollars, that's probably the better part across the four major banks of $50 billion of market cap of underperformance. Obviously, if you were a Telstra shareholder 8 years ago, you wake up one morning to find that the government had appropriated the network and had given you some compensation. So across sectors, across time, regulation is a whim. And generally what happens if you're a shareholder is if you are making excess return, governments, especially if they're running a deficit or otherwise need some extra sources of cash, they can and do tend to take it. So, for example, again, just the final point before I leave this, about 10 years ago, there was a suggestion when iron ore prices were well over $100 that there'd be a resources super profits tax. In the UK, after the GFC, there's now forevermore a 10% extra corporate tax applied on banks. Nobody today is proposing there be a department store tax. Generally speaking, if you earn a lot of money, you end up seeing yourself in a position of fragility with respect to government policy. And that's why it tends to be an area where the more regulated you are, the more prone to this you become. And it's why, especially say with healthcare today and with those reforms suggested by Trump a week ago, we think that investors ought to be pretty alert to the implications of that.
Yeah, absolutely. Damien, a question for you. Do you only invest in small caps or?
No, we also invest in mid-cap stocks as well, and can hold some of the portfolio mid-cap stocks, currently around 20% of the 15 to 20% of the portfolios in mid-cap stocks. We just use that capacity depending on the relative opportunities we see in the small cap market versus the mid-cap market and the themes, different themes we can get access to in the mid-cap market, which aren't available in the small cap market. So we do invest in mid-caps as well.
Okay, great. Well, it looks like we've come to the end of the questions. So if there's nothing further, we might end the session. Thank you again to our presenters and to everyone who dialed in. If you'd like to get in contact with Schroders or Perennial, please speak with your BDM or call our support team who can put you in touch. Thank you again and have a lovely day.
Thank you.
Thank you.